Hi CA students, let's revise CA final AFM conceptual revision of derivatives. So derivative is nothing but a value which is derived from the basis. So what is basis? Basis is the underlying assets from which the derivative derives its value. So derivative is nothing but a it can be like a contract or an agreement. So that contract or agreement, that stamp paper, it derives its value from the underlying assets. So based on this contract or agreement, players will play in multiple ways, like hedging or trading or whatever you say. Now let's take a simple example to understand what is derivatives. Let's say if we have a subscription plan like Netflix or Jio Hotstar or Amazon Prime or Z5 or Sony Live, whatever it is. Now we take the subscription plan either monthly or annually, that doesn't matter, but we pay a price for the subscription. Now this subscription doesn't have a separate value. The movies, the upcoming movies, the series, the comedy shows or whatever the platform is streaming, so those gives the value to the subscription. So the subscription plan which we have opted derives its value from the upcoming movies, series, comedies or the existing shows, whatever. So this can be called as a derivative. It derives its value based on these. Now if great movie comes, then the subscription is more valuable, and if the upcoming movies are flop, then the subscription is waste. So derivative does not have a independent value, it only gets value from the underlying. This concept same it applies to the derivative which we are going to study now. Now we understood what is derivative. Now who are the users of derivatives? There are four types of users: corporations, individual investors, institutional investors and dealers. So corporations are nothing but the companies which used to hedge for currency risk and inventory risk. So currency risk is nothing but if you are exporting or importing, then we will get, if you are importing then you have to pay in dollars or other foreign currency, and if you are exporting then you will receive the foreign currency. In that case you have to convert it to the home currency. Now since there is a risk involved in the exchange, let's say if you are selling a product for $1,000 and at that time the product price might be 100, like sorry, the currency value might be 100, you are thinking that you will get 1 lakh. But so based on this you are calculating the shipping cost and all those things, and you are arriving at a cost of 95,000. But the currency has dropped down to 90 rupees, so in that case you will get 1000 into 90, only 90,000. So here your cost will be 95,000 and you are getting a loss of 5,000. To avoid these type of risks, you will enter into a hedging contract, or you will hedge your currency at, let's say, 100. Now you will enter at a forward contract also, or there are other ways which we are going to see in the upcoming session. Now since you will hedge your currency at 100 rupees, you are telling I will give after uh, sending my goods, I will give you only at a rate of 100 rupees. So that's how you will hedge the foreign currency. Hence you are avoiding, you are always keeping your margin of 5,000 profit and avoiding the currency risk. Same case goes with inventory risk. So we'll see in detail about this hedging concept. Next, going further, individual investors. So like you, me and all, we will, everybody might have a trading account, or we would have heard about a trading account. So where we will buy and sell shares, and those ways. So speculations and hedging and the yield enhancement is nothing but you buy at 100 and then you will wait till it gives you return like dividends or whatever, and it will enhance the value. So for all these trading purposes, this individual investors use the derivatives. And institutional investors, so institutional investors are nothing but the mutual fund, pension fund, insurance companies, asset management companies, Those institutional investors, they will handle huge money. Either they will work on enhancing the yield or increasing their own profit. Either way, so since managing funds, this derivatives will help in giving a good yield, or it just helps in protecting the margin, or whatever you say. That's what the same thing. So hedging asset allocation, yield enhancement, and avoiding arbitrage opportunities. So this also we'll see in in the upcoming session. Now dealers, those are brokers who even they use derivatives as a mode for hedging on the position taking, and exploiting the inefficiencies of the market and earning some dealer spreads. Now going further, there are two types of markets. One is cash market and another one is derivative market. So cash market is nothing but what we actually trade in, the place where actual assets are bought and sold, the underlying assets we spoke, right? Equity, forex, commodity, or whatever it might be. That underlying assets where it is traded, that place is called the cash market. Derivative market is nothing but the contract, the paper, the contract or agreement, those futures, options, forward swaps, the place where contracts are bought and sold, not the actual assets. Now, derivative types might be forward, futures, options, swaps, and commodities. And in derivatives chapter, forwards, futures, and options are covered. Swaps are covered in uh, IRRM chapter, that is a separate chapter, and currency is covered in forex chapter. Okay, so going next, difference between cash market and derivative market. Now, in cash market and derivative market, first one is what is traded. So, tangible assets like shares, commodities. So, those tangible assets are sold in cash market. Now, in a derivative market, mostly it will be intangible assets, the contracts or the papers which is based on the underlying assets are traded here. Minimum quantity can be even one share in case of cash market, but in a derivative market it cannot be like that. There will be lots given, so we cannot buy one share, but one unit we will buy. So in case of one unit, one lot, there will be minimum allotted shares to be bought. For example, if you are buying a Reliance derivative, let's say a forward contract or futures contract. Now, minimum you have to buy one. So minimum a lot will be equals to 1300 shares. So it's what lot size will be fixed in case of derivative market, and in case of cash market there will be nothing. You can buy even one share. Now the risk level are considered more in case of cash market, and derivative it's limited to only margin money. The concept of margin money also we'll see later. Now the purpose of cash market will be mostly for consumption or investment, but in case of derivative market it is hedging, speculation, and arbitrage. Now in case of relation, so value will be equal to the price of the asset, but in derivative market value will be based on the underlying asset. Account requirement will be demat plus trading account. In case of derivative you will have F&O account, futures and options trading account. Now payment requirement, you have to buy the whole share and sell the whole share in case of cash market. So 100% of the value you have to pay upfront, but in case of derivative market you will pay only the margin money. So usually let's say 20%. If the value is 100 rupees, you will have to pay 20 rupees as margin money. I'll explain in detail. Now ownership, buyer becomes a part owner, a shareholder in the cash market, but in case of derivative market there is nothing called as ownership. You cannot own any of the underlying asset because it's just a paperwork. It will be a contractual right or obligation. Now we have seen forward, futures, and options and multiple things. Let's see individually what are those. Now, first, forward contracts. Forward contracts is a private agreement where the seller must deliver the asset on a future date. The buyer must pay a fixed or pre-decided price. Example: let's say onion or tomato. In case of either onion or tomato, the farmer is selling to the trader. Now the agreed amount is 5000 kgs of onion. Farmer will sell to the trader. Delivery date will be 15th March 2026, and delivery place will be Bangalore, and price per kg will be 20 per kg. Now this is what the farmer is entering into a agreement with the trader, saying that on 15th March I will deliver 55,000 kgs, and the place will be at the Bangalore, and then price per kg of the onion will be 20 rupees. Now farmer is taking the short position that he will sell in future. So short is nothing but sell, and buyer is taking, the trader is taking the long position, nothing but he will buy. Now what will happen from today, let's say 15th of March, after 3 months, now it's around November, so in 3 months the farmer will sell. At that point of time, whatever the price might be, let's say even the price can go up at 22 rupees per kg, or the price can go to even 10 rupees or 15 rupees, but still the trader will buy the onion from farmer at 20 rupees. Hence farmer's interest is protected, so he don't have to worry about the price fluctuations or about his cost or whatever. He will have his fixed margin. Trader might gain also, might lose also, so hence this can be considered as a forward contract. Now this is another form of hedging also, because here farmer is entering into the trader at a price of 20, so he is hedging his price at 20. So if he avoiding a future loss, and profit doesn't matter, because he will have his own calculation and margins, keeping 20 as the base amount, so you don't have to worry about it, right? That's how forward contract, a derivative, helps in keeping a farmer save his interest and money and efforts. Now going further, future contracts. Future contract is an agreement where one party agrees to buy an underlying asset in the future, another party agrees to sell the underlying asset in the future. Both lock a specified price today. So same way here in forward contract it can be anything, and but in futures contract it will be the underlying assets. Now delivery or cash settlement happens at the expiry date. Same way in a forward contract we saw the delivery date, right? Same way here also, the delivery or cash settlement. In case of forward contract, delivery has to happen. Let's say farmer has to give the trader 5000 kgs of onion, and trader has to pay the farmer 5000 into 20, 1 lakh, no sorry, 10 lakh. Now in case of future contracts, it need not be delivery, it can be cash settlement also. So what is this cash settlement? Now let's say in case of this 5000, now 5000 into 20, which will be 10 lakhs, 5000, sorry, 5000 into 20, 1 lakh. Now instead of 20, it's the price went to 10 rupees. So herein 5000 into 10, it will become 50,000. Now from 1 lakh the price has dropped to 50,000. Now farmer, if the farmer is telling or the trader is telling, no, I don't need, I will not give you onions, or I will not buy onions, we'll just make a cash settlement. So only the differential amount, since the farmer has hedged the price at 20 and the trader will buy the vegetable like onion at 20, now trader has to pay the farmer 1 lakhs. Instead of that, now the price became 10, so balance 50,000 trader will give to the farmer. Now farmer has gained this. Now instead of 20 rupees, if it become 30 rupees, now 30 into 5000, it will be 1,50,000. Now this 50,000 farmer will pay to trader. So that's how future contracts work. In case of forward contracts, here we cannot do this, because in case of forward contract the delivery has to happen, but in case of future contracts it can be settled through cash settlements. Okay, now underlying can be financial instruments and or commodities also. Financial instruments, nothing but your stocks, bonds, currencies, whatever is traded in the stock market. Now commodities like corn, gold, soybeans, natural gas, or whatever. Now margin requirement. So margin requirement is nothing but the good faith money. So to enter a futures trade, both buyer and seller must deposit a small money called margin. So this is what the margin requirement is. Now, because future contracts are risky, why? Because either of the parties might not honor the contract. Because of that reason, they will keep the margin money. So in the same case, let's say instead of 20 rupees, what if it becomes 40 rupees? So farmer can sell this at 40 rupees, right? And trader can buy it at 20 rupees, so cheap for him. So in this case, farmer is losing something, like double the amount he is losing. Hence, farmer might not honor the contract. Instead of selling 5000 kg of onion to this trader, he will sell to some other trader, or he will sell to the consumer at 40 rupees, and then he will earn. So because of this risk, either of the party might not honor the contract. So in case of futures contract, that's why we'll keep the margin money, saying whatever price might be. In this example, let's say 5000 into 20, 1 lakh. Now 1 lakh into 20 percentage, so this will be 20,000. Both people, like farmer and trader, both have to keep it in the margin. 20,000 has to, when the price goes up and down from their respective margin account, this will be debited. Okay, that also we'll see with the example here. Now, who is deciding this margin requirement? Since forward contracts, these are not official, and anybody can enter into a forward contract with anyone. But in case of futures contract, this will be traded in a stock exchange, recognized stock exchange. Hence, this margin money requirement will be decided by regulators, exchanges, or brokers. Okay, now we'll see with this example. Now here buyer and seller enter a corn futures contract. Now quantity will be 5000 kgs and futures price will be 5 per kg. Now contract value is 25,000, 5,000 into 5. Now on settlement date, if the price became 5.2, the price is increased by 0.2 per kg. Now in this case, B is gaining, the buyer is gaining, because he will buy at just 5 rupees and sell outside at 5.2. So B is gaining. Now, as previously told, since each players has to keep a margin money, now in this case, let's say 25,000 into 10 percentage, 2,500 is the margin money. Now since B is gaining 1000 rupees, this 2,500 plus 1000, the margin the margin account of buyer will become 3,500, and in case of seller it will become 2,500 minus 1000, so it will become 1,500. So that's how a futures contract works. Now the process of daily settlement is called the marking to market. Now let's say this future price here, it is agreed upon on 31st of January. Now we are at November 2025 and 31st Jan of 2025. Now from November, let's say if it is 10th, every day if the price, every day on 11th if it is 5.1, on now this 0.1 will get adjusted in both their accounts. Now on 12th it is 4.9, so this again, this 0.1 will get adjusted in both of their accounts. Like this, if every day the settlement is happening, that is called marking to market. So marking to the market price at every day closing price. So daily resetting of price, that's called the marking to market concept. Now the difference between forward and futures. So in case of trading, forward contracts are traded on personal basis or on a telephone call or whatever. But in futures, the futures are traded in a competitive arena, nothing but the stock exchange. Now, size of the contract, in case of forward contracts, there is no standard size, but in case of futures, everything is standardized, like the term of quantity, what amount, everything will be standardized. But in case of forward contracts, it's all up to the parties involved. Now, in case of forwards, it is over the counter market. Over the counter in the sense, nothing but by way of talking, phone call, just on the spot, anything. In case of futures, it will be executed in an organized exchanges. Now settlement happens on the date agreed in case of forward, but in case of futures, it is a daily settlement via electronic or the exchanges clearing house. So this is what we told as the marking to market concept. Now, in case of forward, the delivery date will be agreed upon by the respective parties, but in case of futures, it will be fixed on a cyclic basis. And mostly in case of futures, delivery will not happen, but in case of forward, the actual delivery will have to happen. Now, in case of transaction cost, cost of forward cost will be bid minus as nothing but what they agreed upon. Now, in case of futures, it will be mostly the brokerage fees for buying and selling the orders. And in case of forward contract, it is not subject to marking to market, because when the delivery is happening at that date, both parties will honor the contract, and that's how it works. But in case of futures, every day marking to market happens, and mostly delivery of the goods will not happen, just cash settlement will happen. In case of forwards, margins are not required actually, but in case of futures, they are subject to minimum maintenance of margin. In case of forward, the credit risk will be borne by each of the parties, but in case of futures, the parties need not be bothered about the credit risk, because it is a two-way transactions. And uh, but why? Because in case of forward, the it depends on the parties. So every party has to bother for the credit worthiness, um, because they have to honor the contract. Okay. Now, in case of futures or forward contract, how we price them, how we value them, that we will see now. Here, the pricing, or we call the basis, right? Now spot price minus future price will be called as the, we came across the spot price and future price. So spot price is nothing but the current price which it is selling in the market, and future price is what we agreed upon. Now the difference between these two prices is called the basis. Now why there will be difference? So that's what we are seeing here. Before that, there are two types of market: the normal market and the inverted market. The normal market is also called the contango market, and the inverted market is called the backwardation. Now, generally, futures price will always be more than spot price, and there will be a positive basis, because future price always carries a extra cost, will be cost to carry, which is nothing but the interest cost, storage cost, insurance, etc., etc. Now, basic thing is interest cost, because the value of 100 rupees will not be equal to same after 6 months or 1 year. So same interest cost will be there in the cost to carry, and it can be also seen in this way as the opportunity cost. Now you have 100 rupees, and if you are investing it somewhere in the bank, it will give you some return after 6 months. So this interest opportunity cost will also be there. So that's why your future price will always be more than spot price. In case of an inverted market, it will be ulta, future price will be less than the spot price. This is because there might be short term demands, or there might be supply shortage, or there can be an impact of dividend, or the market expectations also would be there. So this all factors might pull the futures price down. So in normal situations these costs make more expensive than spot. Fine. Now as expiry comes closer, spot and future price always converge, making basis goes to zero. So what does this mean? Let's say now, mm, okay, we will see this with the example here in the next page. Now, as I told, as expiry comes closer, spot and future price always converge or always become same. Now the process of becoming same, convergence, it's called as the convergence. At convergence, spot price will become future price. Let's say we take an example of Reliance. Now on 13 or 3/12/2025, the price of Reliance in spot market is 2250, in future market is 2380. The base is 130, and on 15th there is a change, and at the expiry date 30/12/2025, both will become 2300. This is mainly because future contract of Reliance or future contract of any commodity will settle at the closing spot price at expiry. That's how this convergence works, and this is called as convergence. Now, since we saw there is the future price is always greater than the spot price, and in between some cost is involved, there are two things involved, which is, so mainly this is called the cost of carry. They will call it as net cost of carry. Now uh, this cost of carry includes interest cost, storage, finance cost, etc., and there might be some returns also involved, like dividends or any benefits that arises from holding the asset. For example, as we are accounting for the interest cost or the opportunity cost, the same way we have to account for the returns also. Let's say if we are holding a dividend of if we are holding a share of 100 rupees, and if it is going to yield some dividend between the future price and the spot future date and the current date, then that returns also has to be reduced from the spot price, because currently the price of the share is inclusive of the dividend, so it's going to reduce the price, right? So hence we also have to reduce the returns. Okay, now going further, we'll see what is arbitrage and who is an arbitrager. Now arbitrage means risk-free profit made by taking advantage of price differences of the same asset in different market. Now we'll see this with the most realistic example. Let's say I am in Bangalore, and I saw that the tomato price in Chennai is 22 rupees per kg, and in Bangalore it is 38 rupees per kg. Seeing these prices, I had an idea that if I buy in Chennai and then if I sell in Bangalore, I will get minimum 16 rupees per kg. And I'm planning, okay, we'll take a truck wherein we can take some 110,000 kgs of tomato, and we will see what are the costs involved. Now let's say driver fee will be there, because the kilometers, it is around the distance will be around 330 kilometers, so that driver fee we are giving 1500 per coverage. And diesel cost will be, let's say if it is giving a mileage of 5, now the 330 kilometers divided by 5, 66 into 90 rupees per liter of diesel, now that will be around 5940. And packing cost also will be incurred, because loading, unloading and all will be there. For that we are charging 2000. Packing cost is 1000 rupees. Now total cost is 10,440. Now let's say I don't have the money, but still I can get it at a 2% interest. So my total cost will be this 10,440. This much I will be incurring, right? So that interest cost 209. So my total cost will be 10,649, and my gain now 1000 into 16 will be 16,000. Now overall I am getting a gain of 5,351. So this is called arbitrage gain. Nothing but from one place to other place there is a difference in price. From one market to other market there is a difference in price. Using this advantage, if somebody is trying to earn some money out of this, then that is called arbitrage gain. Who is trying to do this? They are called as the arbitrager.